Hello, my name is Mike Smith. I'm the president and founder of T&K Futures and Options Incorporated. And today's video lesson is a comparison about stock options and commodity options. It's part one of a three-part series that we're doing here. But before we get started, let's go ahead and cover the risk. Futures and options investing carries significant risk of loss and is not suitable for some investors. Past performance is not indicative of future results. And you should only use risk capital for these types of investments. I've been trading commodities now going on 22 years, and a long time ago I was also a financial consultant at Salomon Smith Barney. So I know a little bit about stock options, even though it's been a long time. I think I know enough to talk about the comparison of the two, and that's really what I want to do today, is just compare the two types of assets. Okay, and these are hypothetical. This one is, that's actually a real life trade, but this is hypothetical. And typically, if you've ever done any option selling at all, for stock option selling I should say, you know that there's a pretty high margin and a pretty low return on investment typically. And let's just give this example. Let's say you sold one Microsoft call option and you collected $200 and you had to put up a $3,000 margin in order to collect that. Well, that's a 6% return on investment. I'm not including commissions, fees, or anything like that in these numbers. Just gross, because that's so different for everybody. And that's a 6% return on investment if it expires worthless. And if you've done any stock option selling, you know 6% is probably pretty generous. From what I hear of option sellers, stock option sellers, 2, 3, 4% is typically what they're shooting for. So wanted to make it generous, so it was very realistic here. Okay, now we come over to the commodity option side of the equation. Typically has a low margin and a higher return on investment, and that's because it's a leveraged investment vehicle. So of course it's going to have, because there's more leverage involved in there, so it's going to be higher premiums. So here's what I did for my clients. It was roughly 2 weeks ago, and we sold July crude oil $35 puts, and we collected $540 per put, and the margin that we had to put up was $1,015 per put. So when you do that math, that was a 53% return on investment. Again, I'm not factoring in commissions, fees, or anything like that. Just gross. So if these options expire worthless, that's a 53% return on investment. So over here, you have a 6% return on investment. Over here, you have a 53% return on investment. I don't know why stock options have gotten so popular. And it seems like people are shying away from the commodity side of the equation. I don't understand it. Maybe there was some bad press for commodity options, or maybe just people don't understand it. And because stock options get so much press these days, people just assume that's the way to go. But I'm telling you, if you've never sold commodity options before, maybe it's time to look at that asset class. Just because of the fact of your return on investment, if nothing else. Just if you're doing fine with your stock options, keep doing your stock options. I understand it's hard to change, especially if things are working out well. I'm just saying, maybe, just maybe, you might want to add commodity options to your larger portfolio. That's all I'm saying. Okay. You can call me. My contact information is at tkfutures.com. If you have any questions about this, I'll explain it further. Like I said, this is a three-part series, so we're going to cover more benefits of commodity options over stock options in the next couple of video lessons as well. I also wrote a book all about commodity options, not stock options, called The No-Nonsense Guide to Buying and Selling Options. You can get that on Amazon, so that might help you as well. But that's it for today. I hope you learned something, and hope you enjoyed it. All right, bye-bye.